My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special shortened edition of Mad Money. Welcome to Cramer. I'm going to make friends. I'm just trying to make a little money. My job, not just to educate, but to teach. So call me at 1-800-743-CNBC. Of course, tweet me at Jim Cramer. CNBC will be bringing you live coverage of President Biden's press conference at 6:30. But first, what do you do when the House of Pleasure becomes the House?
The House of Pain.
What do you do when the House of Pain?
The House of Pain.
Changes to a much better address, moving right next door to the bull statue on Wall Street? That's exactly what happened today in this stock market. When investors abandoned tech, and when I say abandoned, I mean people fled from the group like rats from a sinking ship. It was Titanic. They took their money and went all in on the small and medium-sized companies we call the Russell 2000 because we got a much softer than expected consumer price index, a number that shows inflation is effectively beaten, and interest rates are coming down. And that changes the whole backdrop. It's why the Dow ended up 32 points, S&P lost 0.88%, and the NASDAQ, home of the trillion-dollar techs, plummeted a staggering 1.95%, causing lots of people to say, it's over. More on that in a second. The real action, though, was in the bond market, where interest rates really plunged in recognition that the Fed may finally have whipped inflation, which means Fed Chief Jay Powell can start giving us rate cuts in the not-too-distant future. Listen, people don't buy the same stocks when rates are plunging than they do when rates are doing nothing or inching higher. Still, how does that cause big-cap stocks to get obliterated? How could Amazon stock tumble 2.4%? How could Apple stock lose 2%? How could Microsoft fall 2.5%? And holy heck, Batman, what explains NVIDIA's 5.5% dive? First, you have to understand that sometimes the stock market can switch directions on a dime. But typically that only happens because the much larger bond market does something extreme. With the new context of lower bond yields, all sorts of stocks that haven't been doing well this year, stocks of companies that need lower rates, can suddenly get bid up, be bought, because, well, that's what happens when rates go down. What happened today always happens when rates plunge. Make no mistake about it. Today was what we call a first-class rotation, where the market abandons, or more accurately mows down, the former winners and simultaneously anoints the former losers to kings, even if the companies in question haven't changed one bit versus last night. So let me use this moment to teach you about rotations. First, when you see an extreme rally in bond prices pushing yields lower, that will always ignite some stocks, the ones that are suffering from the withering interstitial machine gun fire that happens when rates are all at higher levels. Stocks like the home builders, which have been just punished endlessly by sky-high mortgage rates. For example, I've repeatedly told you that I like Toll Brothers and Lenore. When I do that, I recognize that they truly thrive, and they can't go up, but until rates go down. But then they really thrive. You always need some stocks that are worth buying if rates, which have been on the fence, suddenly make a decisive move lower. Why? Because when bond yields go down, mortgage rates go down too. And that translates directly into more demand for housing. So this is just a roadmap, people. Anything housing today, from Home Depot and Lowe's to RH and Williams-Sonoma, those stocks went crazy. It was like they make AI chips or something. Only a few weeks ago, most people thought that the home building stocks had peaked because their numbers weren't as strong as expected. Their whole cohort was just destroyed, laid to waste. Now with a very cool CPI reading like we got at 8:30 this morning, this very important indicator for the Fed is flashing green. If we keep getting data like that, I wouldn't be surprised if we get not just one, but two or even three rate cuts, not just that September cut that people have been speculating about. But when you get that many rate cuts, your portfolio needs some stocks that soar when rates come down, stocks like the home builders, or at least something connected to them, like the stocks I just mentioned. Let me give you another example. I've been assuming that interest rates would eventually come down because we keep seeing these brown shoots that I talk about every night, signs of softness that tell you that the economy is weaker than expected. Last night, I recommended buying Weyerhaeuser, for heaven's sake, one of the nation's largest lumber companies, because its stock had been in free fall along with the price of lumber. But if anything positive happens with interest rates, I told you that Weyerhaeuser could soar. Well, what happened today? It went up 5%. By the same token, we've been telling members of the CNBC Investing Club that even though Stanley Black & Decker might be terribly out of fashion, its stock is a buy. Again, it's going to make out like a bandit with lower rates. I mean, this stock rallied 4.6%. They couldn't give it away last week. Okay, so now this is what you have to think about if you're me, telling you. Does this make any sense at all? I mean, like, any at all? Not today, no. But if rates keep going down, these stocks will continue to go higher. The Lowe's, the Home Depots, the Stanley Black & Deckers, the Williams & Nobles, they will go higher. The bullish bets made today were all about trying to catch a multi-day rally before it happens, not just getting the gains from a single session. Second thing you need to know about rotations, these moves by nature tend to last for about 3 days. Okay, write that number down, 3. That's how long the average rotation works. Because as much as it's fine to own some of the stocks that won today, there's still not a major chord in the market. In the end, I prefer investing in the major chord, not the minor chord, always. I have no illusions about the situation. When rates drop, they must keep dropping for today's winners to keep working. And I don't think there's enough data on the horizon to keep fueling the bond market's rally. That means even as stocks are pushed up and the rally broadens out to include many long left-behind small-cap names, as well as a smattering of industrials, the big tech buyers will be back soon enough after a few more punishing days. Why is that? Simple. Because in reality, nothing's really happening at the vast majority of companies whose stocks went higher today. We didn't hear anything positive from most of today's winners. We won't hear anything positive from most of the winners tomorrow either, or Monday or Tuesday. These stocks have been left behind for a reason. They have things wrong with them. Sometimes many things wrong with them. They have warts. They have shortfalls. They need rates to go down rapidly. They need investors to look past their mostly weaker earnings. And that is a very tall order, people. Very few money managers have the ability to take the level of pain that they're likely to experience if they stick with these minor chord stocks for more than just a couple of days. If you're in them, remember that unless you get another huge bond market rally today, you likely won't see more big gains. They're only worth buying if you're prepared to stick with them for the long haul, as we are with Stanley Black & Decker. Finally, can you buy the Magnificent Seven? I heard this all day. By the way, no, here's what I heard. I heard that the Magnificent Seven was finished. That's what they get. It's finished, done. I mean, like, forget those. Like Steve McQueen, he doesn't even make it. And Yul Brynner dies in this one. And you know what? I have to tell you, I think that now that they're all for sale and you're looking to buy them, the answer is no. The answer is no, absolutely not. When you have this kind of vicious decline that's infected all the winners, you can't expect them to get out of the intensive care unit that they found themselves in today, go into the recovery room, and then get picked up and taken immediately to rehab. It takes time to recover from this kind of beatdown. And in the meantime, their stocks are likely to drift lower, not go higher. Keep in mind the mega caps are all super stocks, but they're not supermen. They're not faster than a speeding bullet. They're not more powerful than a locomotive. They can't leap tall buildings in a single bound. They need some time, for heaven's sake. So if you want to buy, I say wait a few more days. Let's see how they react if the banks report good numbers tomorrow. Remember, these super stocks have become far more expensive than the rest of the market. Days like today are corrective to that. So the worst thing you can do is gun jump. Bottom line, I say enjoy the rotation. It's historically broadened things out. And tomorrow you'll get another chance to make money with today's winners. But if interest rates stop going down and stop going down hard, then please do not overstay your welcome. Because then the rotation will unwind within a few days. The market's major chords will reassert it, and you'll be saying, Jim, NVIDIA, it's back. Let's go to Jackson in New York. Please, Jackson.
Period.
Hi, Jackson.
Hey, Jim. I just had a question on Skechers. Do you think it's a good time to buy right now? Because it's been going down a decent amount recently.
Okay, I have mixed emotions about Skechers because it's a boom-bust stock. And I've been in the boom, and it's unbelievable. And I've been in the bust, and it's so horrible that I can't do it. So I'm going to say no to that one because it's just hurt me too many times. I need to go to Rob in California, please. Rob.
Hi, Jim. Greetings
Rob, what's up?
from lovely, sunny, cool Marin County, California.
It's so beautiful there.
Long-time listener, first-time caller.
Oh,
Jim,
thank you for getting in touch with us. Thank you.
Thank you. Jim, I'm looking to open an account for my 16-year-old.
Okay. Good idea.
We're thinking CrowdStrike, but it's a little frothy. Love your thoughts.
Okay, here's what you're going to do. You're going to buy some CrowdStrike now, and then you're going to wait 3 or 4 days and buy a little bit more, and then you're going to wait a few more days and buy more. You have to buy that stock not all at once. It has to be bought and bought on the way down. George Kurtz will deliver for you, but you can't ask him to be a Superman. Stocks are not Superman. They are, in the end, stocks. But if you buy it on the way down in stages and then just hold it and keep doing the research, I think your sum will do just fine. So, people, I say enjoy the rotation, but it will not last forever, especially if interest rates stop going down and then we just rotate back to the same old that I heard all day. We're finished, but I don't think so. On Mad Tonight, I'm taking a bite of Conagra with the company's CEO, fresh off of earnings. Get a sense if GOP-1 concerns in the packaged food space are warranted. And today we got a pessimistic report from Delta, which sent the airline cohort lower. So is the whole group just uninvestable? I'm going to give you my take. And later, we'll be bringing you President Biden's press conference on a special early edition of Last Call. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.